Hello and welcome to episode 1 of our discussion series titled Riding Out the Economic Downturn with Mutual Funds. We are discussing the impact of COVID-19 on household investors, what lies ahead, and how mutual funds have done as a retail vehicle for the average Indian household. I am Monika, Halan, consulting editor with Mint, and I have with me Professor Ananth Narayan, Associate Professor, SPJIMR Institute of Management and Research, and Mr. A.Balasubramanian, CEO, Aditya Birla Sun Life Mutual Fund. It's a great panel, and I'm welcoming both the panelists to this discussion because we're doing this at a very, very crucial time because households are afraid of what lies ahead. Investors have had a series of shocks across the past year, which have cascaded into a crescendo with the COVID-19 hit on incomes, wealth, as well as their investments. I do hope this discussion is going to give clarity to the investors as they watch this, to understand what they should be doing, what changes are needed ahead, and what are the prospects for the world and the Indian economy. I'm going to break this discussion down into 3 parts. The first, we'll audit what has happened with the behavior of households, AMCs, the intermediaries. Then we'll talk about the changes needed. And then the last part, we'll talk about what lies ahead. We have seen in the last few months cracking very badly, the equity markets cracking, and we've had stress on the debt fund side. But I want to look at the behavior of households across these 2 asset classes. We've seen equity investors behave very differently, and we've seen debt investors behave very differently. And I'm going to ask Ananth to take us through some of the reasons, Ananth, that, what is it that kept the SIP numbers going in March? We actually saw a jump in the net inflows into funds. This is behavior that you don't ascribe to retail behaviors. Buying when there's blood on the street is not what retail investors are known to do. And on the debt side, we saw market failure, we saw the freezing of the Templeton schemes, and we've seen liquidity issues. So how would you describe what has happened in terms of the behavior of the household?
Thanks, Monika, and thank you for having me on the show. Look, I can think of multiple factors why the equity market participants have kind of held on the way they have. First off, a lot of credit goes to the ecosystem. AMCs, AMFI itself. The culture of investing into equities, which Birla and others have brought about in this country over the last few years, I think is amazing. You mentioned SIPs, systematic investment plans, as a culture that having grown up now to more than 8,000 crores a month of steady flows, average size is less than 3,000 rupees. I think that's an incredible amount of flow coming in. And frankly, we needed this. We needed financialization of savings. We needed people to start, taking part in equity markets and, entering into capital markets and so on and so forth. So there is a good part where the ecosystem rightfully should pat itself on the back. It's done a good job, and hopefully it will continue doing a good job. There is a second part to it, which is a little more cause for us to reflect and think about. There are other reasons why equity investments have held up over the last few years, right? One is, of course, on a post-tax adjusted basis, equity investments have clearly come out to be trumps. Even if you invest into fixed deposits or into debt, on a post-tax basis, the returns are quite low, particularly with interest rates falling the way they have. Secondly, markets such as real estate markets have been in the doldrums for many, many years now. So there is no alternative kind of a situation which has pushed retail investors into equity markets. The second part, which is again a little troublesome, if you can call it that, in a way, this flow of money into equity mutual funds has been a self-fulfilling game. Money has come in and that's held up the markets. In fact, some of the numbers, Monika, for the last 6 years, going up to, let's say, December of 2019, before COVID-19 kind of hit us, on average, we've seen each year for the last 6 years about 90,000 crores of equity purchases by equity mutual funds. FPI investments have been barely 15,000 crores per year, right? So it's actually been mutual fund flows which are holding up the equity markets. And like many other equity markets globally, we are seeing this a bit of a divergence between the real economy and where markets are. Again, pre-COVID, right? Again, for the last 6 years, if I remember the numbers correctly, equity markets have grown by about 11.5% pre-COVID every year, whereas earnings have grown only by 4%. So, at one level, we have to acknowledge this is a flow game. Economics should stop pretending it's a portent of where markets are headed. Market should stop pretending it's a portent of where economics is headed. Flows is what is holding up markets, and mutual funds have done a great job in harnessing that flows. It just tells us that it's good. Financialization has happened. Equity culture has come about. The responsibility on the shoulders of the ecosystem as a whole now is extremely high to ensure that trust is not lost. Very quickly on debt.
Ananth, I'll just stop you. I want to go to Bala because debt we'll discuss a little more in detail.
Oh.
And I mean, some of the points that you have said have been worrying me as well in terms of the depth of the market, that we simply don't have the kind of large IPOs which should have happened, which would have soaked up some of this money. But I want to ask Bala that in the car industry, we say, or they say, we hear that you don't let the lack of roads stop car production. You produce cars and the roads will come. So is this an optimist's view to say that once the retail household money is coming to the markets, do you think that the IPO flow, which should come, will come? Or are we just going to see valuation increases without the requisite earnings which are needed to get that, to justify that this kind of flow? So my question actually is two-part. One is that how do you look at IPOs ahead? And two, do you think retail investors, I mean, all of us then will be partly guilty of building a dream which doesn't really manifest because the market finally did not expand?
Interesting observation, Monika. I think look at the way, as Ananth mentioned about the last few years, the flows that's been coming into the market, thanks to the mutual fund. I think you put the number of 97 crores. I still remember the number peaking at close to about 1,37 crores inflows per annum and post demand, and then kept continuing. And the effort that we put in terms of building SAP as a way of investing in mutual fund, and that got fully accepted. That's where I think the natural flows have started coming in. I think the IPO is actually the function of market sentiment and function of how the investors will look at the good quality companies when they come to the market for capitalizing. And during this COVID period, interestingly, the kind of money that has been raised in the form of offer for sale or in the form of qualified institutional placement and or the form of rights issues, one of the highest probably in the last 1 year time frame. If you take actually some of the issuance that came in the market for offer of sales has been, I think together about 3-4 companies have raised close to about 50,000 crores from the market. The commitment that has come. So that I think goes to reflect the kind of comfort that one is able to build in terms of attracting money, not from the retail investors, of course, come from the institutional investors. The retail investors who have, of course, subscribed to the rights issue, they have again given their commitment and given the fact that is looking at investing for the long term. So that's something, in my view, the capital raising will remain as one of the core area of development of the equity market. And therefore, I think the financial savings will come in handy to provide the equity capital as one of the source of financing for companies. IPO is something we have seen the whole of last year. IPOs were coming back. I think one of the things that has come, which in my view, it's a big change in the behavior of both the mutual fund money managers as well as the investors at large. That if the issue is if it is getting priced properly and the business in which I think the IPO is coming in the market for fundraising, they get sold if it is priced properly, if the business is actually a sustainable business model and the promoter's background is very good. At the same time, if there are companies which are not priced properly and the business is not sustainable, the issue also doesn't get fully subscribed. That we have seen in the way I think the oversubscription has been coming the last few years.
The question really is, why is it that we're not seeing big ticket IPOs coming? Because finally, this is what will give depth and breadth to the market. So even institutional investors, mutual funds, ULIPs, now EPF, all the money is going into the 30 Sensex 50 Nifty stocks. You need far larger issues to come. So You need 50 geos to come. You need that size come. We've not seen the PSU disinvestment happen. We've been talking about it for 4 or 5 years. I had thought that would be something which would give breadth and depth and would then handle this whole big pipeline of retail money coming in. So it does worry me that this money is coming in, but the market is not growing in terms of the pie is not growing as fast, as big, as good as it should have.
I agree with you. I think the ideal situation would have been the companies are able to fund their resources through a good mix of equity and the debt. I think the last 1.5 years, the number of IPOs coming to the markets have also been going down. I think most of the companies today have been expanding their business the last 4 or 5 years, or maybe last 7 or 8 years, and funding it through the debt route, and raising less money on the equity route. And having said that, we've also seen flows coming into the equity from the financial investors at large, and a lot of the number of private equity deals are happening. That's of course happening simultaneously. But to come out to the specific IPO in general, I think unlike US or unlike in the developed market, in India, the number of companies who have been expanding and then looking at raising money from the public at large and looking at the expansion has not been growing. So that's one of the reasons why the market has come back to the nifty stocks or maybe the handful of Sensex companies. It's only because of these companies are able to raise money in the non-public market through the institutional segment. Therefore, they don't find any reason to actually go back to the same set of shareholders or come with an IPO. And second set of companies who are small in size are not able to actually showcase the future in terms of building up a scale. And given the fact that economic growth has been close to about 5.5% now, of course, is going to be negative. In such a scenario, I'm not able to actually look at promising future in terms of giving growth for their own business model in terms of going for an expansion. Hence, feeling the need of raising money from the IPO market is also not growing in sense, growing at large.
Right.
And that's something the market, probably as the market gets better, the economic outlook gets better, you'll probably see the supply coming in and therefore the participation could increase.
Ananth, I want to ask you the debt question. And when I'm hearing Bala say that, it's difficult for the smaller and medium-sized companies to access the market, to grow, we hear something so similar in the debt part of the market, but that's another set of worries, and I don't want to go there right now because that's a different discussion. But the debt fund investor has behaved very differently. And again, in the composition of ownership, we see that it is institutional investor which owns more of, especially on the liquid and overnight funds. The retail investor was beginning to come towards the longer tenure debt funds. That equity proposition has been fairly well understood, but it's been one event after the other, and this has been on for 2 years, so we can't fully blame just COVID. What has gone wrong? Has the industry only looked at the institutional client as their customer and introduced risk to households through this product category? Because this is really, it's eroded trust. Investors who had actually wanted to invest through the debt funds have got scared. It's back to fixed deposits now. So what has happened?
Monika, on debt, I think the story has been very different. Look, in equity markets, one comforting part is there is sufficient liquidity in the underlying market. So, currently, I think mutual funds have assets under custody equity of about 10 lakh crores. Monthly volumes in equity markets in NSE, etc., is about 10 lakh crores. Right? So you have sufficient volume going through. And, FIIs even now have 2.5 times the assets under management that domestic mutual funds have. So there are plenty of players there with plenty of heft actually playing in those markets. If I compare that in the debt markets, again, the assets under management for debt mutual funds is about 10 lakh crores. The real monthly secondary market volumes in corporate bonds and CP/CDs put together, real monthly volumes is less than 1 lakh crore. So you have this fundamental problem where you're providing a daily net asset value. The size of the market has grown substantially, you're giving the illusion of liquidity that, you can actually draw out money on this net asset value if required. Yet, if people jump in to try and redeem 10% of your asset under management, you don't have liquidity. And we saw that in March, right? FIIs were selling, debt mutual funds were selling, and suddenly there was no liquidity in the market. So here is where I think all of us share the blame. It's not fair to blame only AMCs. It's not fair to blame only the regulators, but all of us share the blame. Personally, I would start with the regulator, to be honest. Both RBI and SEBI have been pushing all of us into debt capital markets. RBI has this large exposure framework where they're telling corporates don't only borrow from banks, also go to debt capital markets. SEBI has this new rule as well. Anybody borrowing more than 100 crores go to the debt capital market. So everybody wants the debt capital markets. Yet the secondary market liquidity is simply not there. The culture that you have of equity market trading, the fact that brokers, people like you and me actually buy and sell equities and therefore provide liquidity, is simply not there in debt. How many of us here on this call or our viewers actually hold besides tax-free bonds, actual bonds for trading purposes, the way you would in equity markets? So given the lack of liquidity, I think this problem was waiting to happen. We grew the size of the assets under management with the illusion of liquidity when there was no actual underlying liquidity. When things started to come to a head with ILFS, unfortunately, many of that stuff started to unravel. And then after ILFS, we had other issues coming up as well. Again, fundamentally with that issue of illiquidity. Just one statistic on liquidity, Monika. I think there are about 18,000 separate ISINs or separate individual debt securities. A SEBI report shows that only 5,000 of them trade in a full year. So 13,000, which is more than almost 3/4 of the actual bonds, don't trade at all throughout the course of the year, and yet we give this illusion of liquidity in markets. So here is the good news. I think the correction both in equity markets and in debt markets will happen. We are a growing economy. Our financial investment culture is also growing. It's going to be a journey. It's not we don't have to beat ourselves up for what has happened. Yes, we'll have to learn from this and ensure that things like liquidity in debt markets develop from here. On the equity markets, just one quick point to Bala's point. I think what would worry me there, Monika, is the point I made about the huge rising wedge between the real economy and valuations, right? The fact that flows are coming up into equity markets and holding them up is good. The fact that, to your point on why IPOs are not happening, the fact is the underlying real economy is not growing. There aren't any investments coming through, right? So who actually wants to raise money at this time to set up a new plant or machinery, right? That's right. So what we are hoping is now that this financial infrastructure is in place, thanks to people like Birla, the real economy will start to pick up and get funded by this equity market, which is growing. At the same time, we have to be ready that in case the real economy doesn't really pick up, we don't want to be left hanging, holding, a market which is based on just flows without the real underlying valuation supported, because of the underlying fundamentals. That's right. That's, I think, been everybody's worry. Anybody who understands what's happening, I think we've been worried for some years. And we're just hoping that the growth momentum is such that we have option A rather than option B. Bala, I want to talk to you about the debt. Debt mutual funds as a retail investor vehicle has not inspired trust. That trust has got broken. So we have seen investors coming back because, see, the proposition is very strong, especially when you compare it to the alternatives in the market in terms of liquidity, post-tax return, liquidity in terms of in the products which have the liquidity as a mutual fund investor. But where is it that the industry went wrong? So we have the whole regulatory piece which went wrong. What is it that you think the industry and the distributors could have done differently?
I think it's interesting the development that we have seen in the bond market. I think mutual funds have played very key role in channelizing the money of institutional investors and retail investors and HNIs in bringing into the fixed income market. This is actually the last 25 years journey. I still remember we at Aditya Mutual Fund having launched Birla Income Plus in the year 1996 and ran it till today successfully by giving an average return of close to 8% plus. And despite going through ups and downs on the interest rates moving up, going down, at the same time credit market going bust, and so on and so forth. And one has to, of course, give time for the fixed income market to deliver. The reason why I'm saying that one has to give time for fixed income market to deliver, it has got 4 components when it comes to the question of NAV movement. One is my large component is coming from the interest accrual. Second component is coming on the base of price fluctuations happens on the base of monetary policy movement. And third is coming on the base of the rating upgrade and downgrade also has a price impact. And finally, of course, the default. Whenever actually the goes below the investment grade, it has an impact on a price movement. And all these things have been evolving. And then the large component of the whole movement is coming from the coupon getting accrued in the portfolio that compensate for the investors over the long period of time. So I always believe that fixed income also has to give a long rope. You cannot just say the fixed income, you can come for a short term. Equity only you have to give a long rope. So that's one. And second, when it comes to the question of where the industry would have gone wrong, industry has been playing the broader role of development as well. Though we don't say it in so many words, the very fact that we are channelizing money to come into the capital market through the mutual funds and all of us are actually growing our size, also with the intention of, in some sense, develop the market. We keep looking at investment opportunities. One other area, I think the industry is trying to develop, somewhat mimic the way US has done in developing the US junk bond market. Of course, India does not have a junk bond market. Even the AAA bond market many times lacks liquidity. But the industry took some kind of initiative to actually launch credit-related funds, go down the credit lines, credit ratings below AA and so on and so forth. So you get about 3-4% extra return. And actually, it comes in handy, especially at a time when the rates are low, and look for high return, and that's where you start underwriting below the investment grade bonds. And naturally, of course, when ILFS kind of event that happens, so of course, looking back, one can always blame many things that should not have happened and so on and so forth. ILFS an event is like a Lehman Brothers event in India, and it never happened such a large kind of credit defaults, and never happened that actually led to a series of impact on the NBFCs market and so on and so forth. That took actually fixed income schemes, and given the fact that ultimately the mutual funds, money managers do lend to the intermediary, such as NBFCs, who in turn actually gives to the market at the real borrowers in the market. We don't go to the real borrowers, we go through intermediaries, which is the NBFCs kind of things, HFCs, housing finance companies. The moment that segment got impacted, naturally the mutual funds got it become a target audience. I think the way I think the industry looked at building up the credit market and credit opportunities fund, I remember one of the conversations we used to have, we used to call the credit fund as a credit risk fund. And then we both of us are one of the committee of MF Advisory Council, and we were on the subcommittee.
I was on the credit risk side, and you were on the credit opportunity side.
Opportunity side.
You have to call them credit risk. You cannot call them opportunity. Yes.
Exactly. And ultimately, we went with the giving the right communication. We changed the name from credit opportunity to credit risk fund. Wanted to highlight that yes, there are credit risk is being taken, but it comes along with the risk. So this is where I think in the industry I would assume that they are trying to grow the size and it's doing quite well. An accident such as a large accident such as ILF when it came, and a series of such events, and then the whole the fixed income space came under criticisms. And having said that, I think if you look at since the time ILF has happened, the quantum of the loss, which I think the mutual funds would have taken as a proportion of the total assets under management that we manage, is not very large. But unfortunately, they all run an open-end fund where again instant liquidity, where investors can watch it and see the portfolios and then come and redeem. And whenever the investors, of course, start redeeming, that actually creates some kind of spiraling impact. And that's why I think it's something which is impacted. Right. Second is as a regulation also has helped the industry to give the right message to the people at large. Then the valuation impact that starts coming in. And the moment you start seeing in fixed income schemes, NAV becoming very volatile, due to the substantial change in the ratings, and that does impact actually the investors' behavior. I think all these things coming together, 2018 and 2019 was a year of great learning for money managers, both in terms of ensuring that what kind of exposure one can take, what kind of structures one can do, and what kind of investments one can actually go down on the credit lines, rather than actually we take the lead in actually building up the market. As long as the whole ecosystem is able to do that, then I think mutual funds can actually play a very significant role in development of the market as well as development of the investors' confidence. So therefore, 2018, my view, 18-19, it turned out to be a good learning year, even for fixed income managers in control the risk. I think as time progresses, if you look at money managers have gone to the other extreme of making the portfolio so safe and safe. And today, all of us are making a noise. Safety, liquidity, return comes last. But I think if you're able to maintain this consistently throughout this period, then the fixed income can actually contribute quite a lot to the development of the market as well as channelizing public resources into the bond market.
Right. And so I'm going to actually move to the second part in terms of changes needed, and a related topic with what the conversation has been is that, yes, we called these funds credit risk, but then we found credit risk in all kinds of other schemes. What changes? And Ananth, I can ask you this question. What is it that the regulator needs to do? Because look, it's all about signaling. How do we signal that this fund has credit risk? And debt as a category, counterintuitively, is far more difficult to understand than equity. So what is it? Is there a simple way to mark credit risk in products for retail investors? We used to have institutional only plans. Then, we all said that's not a good idea because disproportionate interest goes there. So now you have one scheme. But then in that scheme, you have credit risk because the fund house is not just doing development, it's also looking for the AUM and wanting that extra business. So one is, how do you identify credit? And the second question is, and that, I'll take it back to Bala then, is that why don't we have a liquid bond market? This is something a lot of investors constantly ask. Why is it that India does not have a good corporate bond market? So, but first, Ananth, and then I'll jump to Bala for the corporate bond market question.
So I'll give you my two-bit personal views on this, Monika, on this categorization of debt and how do we make it safe, etc. I think there are three aspects to a debt fund which need to be specified. One is the liquidity of the fund itself, which means if I need the money, can I really get it out at any point in time, right? Second is the credit quality of the underlying papers, which is the real credit quality, which means, how risky is it on a rating scale, etc. And the third is the duration of the fund itself. Is it short duration? Is it carrying high duration? Which means, is the interest rate risk inherent in that portfolio large or small? I think we should do a recategorization of the various schemes that we have, medium duration, long duration, and credit fund, and so on and so forth. I think that requires a recategorization based on these three parameters. There are, of course, indicators which are supposed to tell investors about the riskiness of portfolios, right? So you have a riskometer, right, which is supposed to indicate or give a broad sense of where things are. Now, I don't want to take specific schemes names, but there were 6 schemes which were shut down a while back. All of them were categorized as medium risk on the day when they were shut down, right? So there's clearly room for improvement. And it's a journey. And this is not to beat up somebody. They're all good friends. It's a journey. It's a part of a journey. Specifically on liquidity, I would use a test of something like this. If you had to unwind 25% of that portfolio, of that scheme, how many days would it actually take you to do that? Is it possible at all? And if you can, how many days would it take you to do that? And it's not just getting rid of the most liquid bonds in that particular scheme, but doing some kind of a pro rata of that entire scheme so that you don't leave investors one way or the other. Likewise, with credit rating, on the second parameter, it would probably be some weighted average rating of that particular papers. Hopefully, credit rating agencies have been beaten up enough as well, thanks to all the stuff which happened around ILFS, etc. And hopefully they improve going forward. So maybe rating agencies as well as the credit shops within the AMCs itself would do a better job. Earlier, you had 2 people, manning a portfolio with several securities being invested in. Now, every fund, I think, has invested a lot more in beefing up their credit risk teams, etc. So hopefully there's a journey which is ongoing. And so a weighted average indicator of the true credit risk and followed by duration. So I think these 3 parameters would probably be the way to go. I'm sure we will discuss this in various fora, Monika, but I think we can arrive at a way in which we can describe the real risk to an average investor.
Right. So there is a recategorization that SEBI's exercise was actually half done. I do remember I was also part of the subcommittee, and when the debt categorization came, I think the room just broke up into almost fights because we had no consensus on where we were going. And I think these market events will probably lead to consensus on where we have to go. Bala, quickly on the bond market, a lot of investors ask this question. So please tell very simply, why don't we have a secondary market in bonds, corporate bonds?
I think if you look at the players, the players, most of them are like insurance companies. They're only long-only buyers. They actually buy the bond and sit on it. The banks, they buy the corporate bonds. Again, they don't trade actually the corporate bonds so frequently. for one simple reason that one, of course, they need to what kind of volume that they can generate when they out actually buy and sell securities in the corporate bond side. And most of the people adapt to the principle of hold till maturity as a concept when it comes to the question of investing in bonds. Whereas if you look at the other way around in the government securities market, which is the most well-traded market and extremely liquid, and again, people trade in that market. Most of the corporate treasuries trade in the market, and they actually have the habit of making as a trading on a daily basis. Even for a few yields movement here and there, they will trade. At the end of the day, they will count how much money they are making. Whereas the similar kind of counting generally is not in the corporate bond market, given the fact that they can't trade in a large volume. The market is always one-sided. Mutual funds, given the fact that we actually get money on a daily basis of quantum, and therefore we are there in the market an active participant. A similar active participation doesn't come from the other financial institution investors, such as insurance companies, such as the bank treasuries. That primarily is one. Second is in the case of retail and HNIs, unlike in equity where they can actually come and punch in the trades and buying and selling of bonds. Whereas in the case of fixed income, a similar kind of day-to-day, people actually look for investing in say lakh of rupees or 5 lakh rupees I want to invest, and therefore I buy this bond at certain yield. It's quite complicated. I mean, when it comes to the question of bond buying, it's not as easy as the buying and selling of equities. That's something which again is the reason where the retail participant doesn't happen. Retail participant happens through mutual fund and insurance. And since I have also been part of the corporate bond market development committee for the last 20 years, and that reminds us is still a problem. There's only one area where we have made a huge progress in creating a liquidity in the NDSO market. Maybe you will probably start thinking a similar NDSO market can it be created for corporate bond market in order to bring in a higher level of participation coming from players like us and insurance companies. When they come to the market for buying and selling, they come to that NDSO equivalent in the corporate bond market. Maybe that could help. But it has taken some steps in the recent past where most of the issuances that's coming more than 300 crore. Now, of course, all issuances have to hit the exchange screen. They need to, of course, bid for it. And we are now seeing sometimes we have actually closed the transaction with somebody and you go and hit the screen and suddenly you will find your bids are not getting accepted. Somebody else is getting bidding accepted because he is better off by you by about 3 basis points. Just beginning, in my view, I think if it takes off, you'll probably see the corporate bond market becoming more liquid as we move forward.
The mutual fund market has sort of expanded. It's grown fairly well, but this is just the beginning. An Indian investor wants high return and no risk. That is the demand. That's the product they want. That product doesn't exist. But Ananth, I'm going to ask you, is there a way to put products in a box which don't have fund manager risk? So for instance, you're an entry-level mutual fund investor and you want products for holding for, say, between 7 to 10 years, and you could be wanting for 5 years. Is there a way that advisors or writers or whoever can, without a conflict of interest, advise them to put a few products in a box and say, look, this is good for 10 years?
Well, it's a tough one, Monika. So look, let's face it, it's a nascent industry. There's a long way to go. Suitability and appropriateness of selling has a long way to go as well. I think you have to accept that. I don't know, Bala would know better. I think there are more than 1 lakh, AMFI registered advisors at this point in time. It's impossible to actually monitor how sales are actually happening from them. I'm sure every AMC does what they can, but it's very difficult to do that. Now, the good news is some amount of categorization which has happened in funds will help. For instance, when you have a large cap fund, that tells you that you're putting money into reasonably good stocks and therefore should be less risky than, for instance, into a small cap fund or a mid cap fund, etc. Likewise, hopefully when we have the new categorization on the bond funds, even now, for instance, when you have low duration fund or when you have overnight fund, etc., you know which is safe and which is not. And hopefully some categorization is happening out there. But a lot more needs to be done, to be honest, Monika. And here are a few things I would want the industry to do, right? First off, things like ETFs, for instance, ought to be developing a lot more. The fact is we don't make entire disclosures about what charges are inherent into what products. You have a regular fund and you have a direct fund and, everything is put into the NAV itself. Of course, disclosures happen in the website, but how many investors actually go through the website and see what the actual breakup of charges, etc. So it's a translucent or a less transparent kind of a situation where people don't know what charges they're facing. Simple products like ETFs, where you're not looking for alpha, you're just looking to mimic a Nifty or whatever the benchmark is, those aren't really picking up. And I suspect it's partly because they don't pay enough money to the fund managers to offer those kind of products. So I think a lot of work needs to be done. I'll just add one more thing, Monika. To your point about offering good products and taking care of small investors. I think mutual fund industry realizes now that particularly with SIPs, with 2,600 rupees of average SIPs totaling up to 8,000 crores going every month, they're already in a huge fiduciary responsibility of managing small investor money, right? It's almost like banks now. In fact, it's as bad as banks, wherein, you no longer have the luxury of saying, what, I told you mutual funds are subject to market risk. It goes beyond that. The fact is you are handling small people's money and the responsibility goes extremely high on you. I'll tell you what mistake we made as bankers, as a former banker, right? 10 years ago, 12 years ago, before the global financial crisis, we were overpaid. We were having a great time selling our complicated products. And we decided that, people are there, they're bright people, they're signing up to the documents and okaying the trades. So that's it, let me count my bonus and move on, right? Now, we knew there were things not going well. The smartest people are the guys in the front office. They can see what's not going right. Regulators will catch on 3 years later because, they're not there in the front line. They're not seeing what's happening in the front line. So when a LIBOR scandal happened, for instance, I'm sure the banks involved knew there was something wrong for many, many years. The point is you've got to nip that in the bud the moment you start becoming the handling fiduciary risk. So I think a lot of responsibility falls on the industry itself not to repeat the mistakes that bankers made 10, 15 years ago. Recognize that, it's okay to cut down on business, but be completely honest and open, self-correct and self-regulate rather than wait for others to do it for you. I think that is a kind of attitude you probably need to start off with in AMFI, etc. I think it will happen. This crisis, in a way, will probably push us towards that. But I think we still have a long way to go on that.
Bala, but you've been part of the industry for many, many years. We've seen the AMFI processes. This is really an idealistic place to be, that we know what the problems are. And before somebody comes baying for our blood, and that has happened in the Templeton story, we know what kind of Twitter and social media messages were going out about the fund manager. So, it's a reality that baying for the blood does happen. How probable do you think is this idea that the industry can itself self-correct rather than having a regulator? And again, so the regulator has had to specify the font and the speed of the disclaimer. The regulator has had to do micromanagement. And, we have all been part of the committee. We've seen incrementally how micro the regulations have had to get simply because the industry then uses loopholes. So do you think that in this case, there will be success because of the fiduciary? Because Ananth is making a really important point. This is household money.
Yeah. I think Ananth made one or two interesting points, which I fully agree with him in terms of one is the fiduciary responsibility. Yeah. And as your industry size becoming bigger and bigger, not on base of ticket size, but on the base of the number of investors, then naturally the responsibility for money managers to fund house to manage the money more in an efficient manner increases quite substantially. And having done that, I think you asked about a specific question on how we can self-regulate. So having been part of the industries, I think one of the things which I admire the mutual fund industries is only for the regulatory changes that has come. Most of the times, I am a firm believer it has come not because the regulator wanted to do it, not because we wanted to do it. And there were some incidences which actually comes and impact the MF industries and therefore impact the sentiment of investors and creating some kind of apprehensions about investors on mutual funds. Then, of course, we all get together and then form a regulatory framework, and that's where it got evolved. I think one of the areas where we can actually do much better is about, I think you have everywhere there's element of fear and there's element of greed. And mutual fund always has one greed element to all of us, which is nothing but building your AEM, building your AEM, building your AEM. And that's something which is the number one, number two, number three is the craze, of course, it happens. The two is bigger than each other. I think the moment you actually shift the measurement criteria from an AEM actually to say the penetration that you have done, the number of customers you have added, that small ticket size that actually are built in terms of retail assets, and so on and so forth, and start giving less importance for the absolute amount of AEM that you manage at the top level. I think the moment actually look at some of the metrics that which you are being the measurement of the success of the AMCs, I think move away from that, not just from the regulation. Regulation doesn't say anything. It is actually the public at large when they look at 3 lakh crore was large AEM, then you start looking at, you don't ask a question that how much is coming from institutional investors, how much is coming from treasuries, how much has come from retail investors. These questions are normally asked and not asked when you look at the overall AEM. The moment you move away from that and what gets disclosed in the public at large, only about retail AEM, retail customer base, ticket size, and so on and so forth, how much penetration you have done, and how much is the market in which you're operating in order to actually serve the large pool of customers, and then start focusing on what are the kind of service standards that have improved, not just only on the base of return. Return is a function of fluctuation in the market, and various variables goes into that in calculating it. I think how well actually we are actually carrying out the fiduciary responsibility, including providing integrated service to investors. I think if you change the measurement criteria, I'm sure that the question what you asked would go up quite significantly from increasing the responsibility of people at large.
Yeah, we are moving to the third part where we're looking ahead. And at the moment, there is a lot of fear on global recession and the Indian economy stalling. So Ananth, first you and then Bala, your predictions on what is going to happen. So right now, when you hear some conversations, sometimes I think people think we're going to go back to hunting, gathering and living in caves. It's not going to happen. We will recover. But, what is a mature estimate of the world going into a recession? And where does India stand?
I'll stick to India, Monika. And the reality is, like you rightly said, who the hell knows? It's a very, very uncertain world. Things are changing almost every day. But the reality is we entered into COVID-19 already weak. Our banking and financial ecosystem was not good. We had sectors such as power, real estate, telecom, airline and shipping, which are not doing well. Our employment wasn't great. It wasn't as if we were seeing a lot of new investments and new jobs being created. So we entered in weak. The lockdown has been the worst or the most tightest in the case of India, and the fiscal response has been probably the weakest, right? And for the right reasons, the fact that we don't have too much of space, etc. So we are going to take a body blow through COVID-19. We are going to see a contraction, maybe 5 to 6% of growth. Who the hell knows? We'll find out. There is deep distress amongst workforce as well as businesses. We will see the non-performing assets of financial institutions going up. We will see more, fiscal deficit slippage and printing happening. Now, all this is bad news. But as you rightly said, India's future will always remain bright. Our potential is tremendous. We are a good set of people. Our people remains our strength. Hopefully, we use this crisis as we did in 1991 to pivot towards actually creating jobs and output going forward. And that potential always remains. So it's a question of, if we pivot towards what the Prime Minister mentioned, land reforms, labor reforms, law reforms, getting in supply chains from China, starting manufacturing and in India and getting the supply chains. I think as long as we can create jobs and output, which will be the second level of second generation reforms coming through, I think our future is going to be bright. But we can't take it for granted. A lot of work has to happen. Hoping and praying that we do use this crisis to actually, they say that we reform at the barrel of a gun, and here is a barrel of a gun, and the best time for us to actually pivot towards that. So I think we'll remain optimistic on India's chances, but we can't take it for granted. I'm just hoping, Monika, that the other thing besides jobs and output, one thing we should pivot towards is healthcare, education, and nutrition for our children. Hopefully, this crisis will tell us that we need to invest in all of these three things, which we've not been doing so far. And hopefully every government, state as well as central government, and all of us put together will start to pivot towards that as well.
Right. Bala, how do you look at India in the next 6 months, 1 year, 2 years? What lies ahead?
I think I agree with what Ananth mentioned about India looks continues to remain promising, given the fact that one, young population, and second is rural economy continues to the driver of the Indian growth. And consumption remains a large theme of the driver of India growth rates. And having said that, when government also has been taking many steps in during this period of COVID, they have taken many steps to support the economy in terms of reviving the growth. But of course, one cannot take it for granted that things will actually come back pretty fast, given the fact that there's also been a delay in terms of executions. I think the way the Fed has reacted the last few months during COVID period is something unimaginable. That I think we can't say that we are closer to what Fed has done. Not just only pumping in liquidity, even ensuring that money reaches the right people with respect to even including the corporate world. And that's something I think India is yet to get. Though liquidity has been quite large, I think unless central credit market comes back to normal, we'll probably not able to get to a higher growth trajectory, which is what I think probably all the efforts has being done, both at the government level as well as the Reserve Bank of India level, to boost the confidence in the credit market, which probably will take a few more months. It's not going to come in a matter of 6 months' time, for which I think larger ecosystem has to get adjusted. Yes, it's now time to take rather borrow and spend. And that I think cycle will take some time to come back. At this point of time, I think 6 months is going to remain volatile because there are many drivers of the market are not, we can't say that they are being driven, except only one factor remains good for India point of view. One is the liquidity, and interest rates are low, real interest rates are getting contracted, therefore equity as an asset class may get flows globally, therefore that could keep the overall sentiment intact. And second, of course, the largest macro factor which are going in favor of India is the oil price staying where they are. I think if we get some of our execution piece right, probably we can expect next 1.5 years time frame the economy to come back to normal. I think India will remain as a promising country, absolutely no doubt on that. I think the speed at which I think it can come back, probably we'll see a gradual uptick rather than the general belief that the V-shaped recovery one can expect. Probably that could still be tested.
Okay, and I have to say that going through that March-April period, I reworked some of my own personal money rules. So having done what I've done all these years, we all have rules that we follow. And I realized that I was over-invested into equity for my age and stage. Right? So we all hate to sort of accept the fact that retirement will come. So I realized, because everything is stalling, you realize that there is an age and stage where your asset allocation has to become more conservative. You cannot be as aggressive because you've done the numbers and because you know the markets. So my personal learning was that asset allocation, even for me, are not mere words. I need to personally follow it. Ananth, first you and then Bala, any learnings, candid learnings on what this period told you about your money?
A few things I was kind of happy with, Monika. It's been a terrible time. Obviously, all of us have taken a knock in one way or the other. One is I've been using an advisor for a long time. Even though I'm supposed to be a markets expert, I don't trust my own money with myself. I do use an expert. And by the way, I invest in mutual funds, even though I give them lots of galis separately. But I do invest in mutual funds. So my asset allocation was reasonably robust. It was not weighted towards equity in a big way. It had equity, debt, liquid funds, as well as a bit of real estate. It also had other currencies, by the way. It was not just in rupees. It's also weighted across different currencies. So overall, the portfolio is not done that badly. And I think the fact that I was using in fact, I used your book as well, Monika. So the fact that I was using an asset allocation portfolio helped by my wealth manager helped me. So that's been one learning. The second learning really has been that, look, a year back, who would have thought all this will be, what we'll be going through, right? So personally, one learning has been to keep your eyes and ears open and to never say no. Even if an idea sounds wild, don't throw it out as being, it's good to have doubt in your mind. In fact, I'm going to end with that particular research, which actually shows that women are better investors than men. And the reason for that apparently is that behaviorally, men have much less doubt and therefore tend to trade a lot more and then tend to lose a lot more. Women have a lot more doubt in their heads and therefore trade less and therefore consistently make better returns. So the good news, or the good thing I've learned, is to have doubt in your head is absolutely fine. If you have too much of surety about something, you're probably doing something wrong.
Yeah, my key learning has been, of course, as you rightly put it for yourself, I've been overweight on equity, 100% of my money within my own mutual fund. And having gone on overweight, sometimes I look at how much of the return has come from equity in the last 3 years and 5 years, and I suddenly realized that I completely ignored fixed income as an asset class as part of my allocations. One of my biggest learning is don't even ignore liquid fund, though it may look very simple idea. Park your money, get about 5-6% return. Don't ignore that fund as well when you're investing in mutual funds. I realized last year some of my own income I started allocating to fixed income, even liquid fund to the extent which can come in handy for emergency. Second is, of course, being a working employee, you also have the advantage of making the statutory obligation that you have for investing into the PF. Also, that comes clearly handy for your retirement planning. That also cannot be ignored given the fact that government provides some kind of voluntary PF contribution facility they are giving. I think look at that also as one of the opportunity. Don't ignore any opportunities. Look at all opportunities. The stream of investing into various products ultimately creates a success. It's not about one product, such as high risk product, gives you the long term wealth.
One other thing that a lot of people actually have done is very morbidly been pushed to make their wills. So that has been the other thing, because this is a disease which is not looking at your net worth, and your money is not going to get your way out of this problem. So I have personally had people calling saying that we have to make our will, and that this is really the seriousness of this disease. I've really had a really good time discussing issues which have been bubbling in my mind. So I want to thank Bala, you, and Ananth, you, for a really fascinating conversation. And I hope to do this again, talk to you again, because a lot of investors have been worried and possibly will find some answers. So thank you both. And thank you for the viewers for watching. And we will be back soon with another edition.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.